Hi, everybody. This is the third video for Chapter 9, where we're covering different criteria for making financial decisions, deciding whether or not a particular investment project is worth pursuing or not. There were six different criteria in the chapter, but we were only looking at three of them, and this is the third one. The first one was net present value, second was payback period, and the third one here is called internal rate of return. This criteria, the internal rate of return, is definitely the most important alternative to the net present value process, which we said was the primary and best way to analyze investments. But you'll also see the internal rate of return used pretty frequently. It's intuitively appealing. What that means is that it's really easy to understand for most people what a rate of return represents. When you tell somebody this project generates a 16% rate of return, they usually know what that means and have some understanding of whether that's a large or a small rate of return. Another nice thing about it is that it's based entirely on the cash flows and doesn't require you to specify a discount rate in order to be able to calculate it. All you need is the cash flows. The definition of the IRR is that it's the rate of return that makes the net present value equal to zero. Now, if we think about this, we could write out the expression for net present value in this way. This is a pretty simple expression of the net present value where we're just taking supposedly three cash flows, cash flow in year 1, year 2, and year 3, finding the present value of each of those discounted by interest rate R, discount rate R for 1 year, 2 years, 3 years, respectively, and then subtracting the initial cost. That's very much how we calculated net present value in the first video in this sequence. What's happening in internal rate of return is that we're trying to find the rate of return that makes the net present value exactly equal to zero, setting the left-hand side to zero and finding the value for R that makes that expression true. Plug in a value for R such that the present values of all of the cash flows added together are exactly equal to the cost of the investment, the time zero cash flow. Basically finding the rate of return that equates the present value of the benefits to the actual cost of the project. And this can be pretty tedious to do. Mathematically, that's not a tractable problem. It's not something you can do by just solving to put R on the left-hand side of the equals and getting some expression on the right-hand side that tells you what it is. Either a financial calculator or a spreadsheet can be used to solve a problem like this. Let's take a look at doing it using the spreadsheet approach. Okay, here's a spreadsheet which was introduced in the first video. We used it to calculate the net present value of an example project, and we see the same information presented. There's a cost of capital, a weighted average cost of capital of 12%. There are cash flows. There's an initial cost of $165,000, followed by incoming cash flows of $63,120 first year, $70,800 second year, $91,080 in the third year. And as we saw back in the first video in this chapter, net present value comes out to be about $12,627. We said that this represents the value of the benefits of the project in excess of its cost. The project creates benefits of about $177,000. And it only costs $165,000, the difference being this $12,000 net present value. That, of course, depends on the cost of capital that's specified, the discount rate. that discount rate is being used to find the present values of all those future cash flows. And as we know from previous chapters, the higher the discount rate is, the less those future cash flows are worth. Higher discount rate, lower present values. If we change this discount rate to, say, 10%, probably not a big surprise that the net present value goes up. Why? Because with a lower discount rate, these future cash flows have a higher present value. They're worth more. If we change the discount rate in the other direction to, say, 14%, the net present value becomes smaller. Again, with a higher discount rate, those future cash flows are less valuable today than they were before. The idea of internal rate of return is how high does the discount rate have to be before the benefits of the project no longer outweigh the cost? And we can do that by trial and error. I'm just guessing at numbers here. 15%, I'm still seeing a positive net present value, which means at this discount rate, the future cash flows are still worth more than the cost. 16%, getting there. This is still positive, but pretty close to zero, actually. If I keep guessing at this, 16.1%, let's say, I'm looking for the rate that makes this exactly equal to zero. 16.2, it's way too, well, not way, but it's too high, because now we've reached the point where the discounting of the future cash flows makes the future cash flows less valuable than the initial cost. Need to back up a little bit. It's somewhere between 16.1 and 16.2%. I can go in between. This is still a little bit too high. You can see I'm getting very close here in this net present value cell to zero. This is a little bit too low, but we're getting close. That's close enough, within $1, making the net present value zero. By trial and error, I've found the rate of return, the discount rate, that makes the net present value of this project pretty much equal to zero. And what I found here, this 16.132%, is what we would call the internal rate of return of this project. It represents the rate of return that the company earns on its capital if it invests $165,000 today and gets back these cash flows over the next 3 years. By trial and error is one way of doing this, but not the only way. Spreadsheets provide an easy way, a formula for calculating the internal rate of return. You can see I've typed it out here to the right, but it really is just that simple, equals IRR. Inside the parentheses, put the cells of the cash flows including times zero, which is a little bit different from net present value, but that's what you have to do. Internal rate of return over all of the cash flows, starting with times zero. Press enter. 16% is approximately right. If you give another couple of decimal places, you'll see that the formula returns the same value that I found up here by trial and error. You don't want to be doing this by trial and error. You want to use the formula or a financial calculator to do this. So having calculated the internal rate of return for this project, we can see the result we got is the same as here on the slide, about 16.13%. The question obviously is, do we accept or reject the project? Well, the decision rule that was specified with the internal rate of return was to accept the project if the IRR is greater than the required rate of return. And in this situation, we were told that the required rate of return was 12%. We're happy with this investment if it generates a rate of return of at least 12%. We've just determined that it actually generates a rate of return of 16.13% on the capital employed. So, well, accept this is a good project. Accept the project. In evaluating this process, deciding is this a good way to make financial decisions or not, well, the textbook asks us 3 questions basically about each one of these. Does the IRR rule account for the time value of money? Yes, it does. It accounts for the time value of money in that cash flows occurring in the future are given less weight than our cash flows occurring in the present. Further in the future they occur, the less value they receive. Yes, this is true. It does account for the time value of money. Does it account for risk? Yes, but sort of indirectly. It doesn't account for risk when you calculate the IRR, but when you compare the IRR to the hurdle rate, to the cost of capital, you're comparing the return of the project to an appropriate risk-adjusted discount rate that reflects how risky the project is. So in use, yes, it's true. This does work. Does the IRR rule provide an indication about the increase in value? Not really. It tells us the rate of return that a project generates. How much extra value do we receive per dollar invested per year of the project? That's the rate of return per dollar, but it doesn't tell us how many dollars are being created. So there's a little bit of a disadvantage in that. It's not usually going to reverse the decision, but there can be situations where that matters. Because of that, we probably wouldn't consider the IRR rule the primary decision-making rule, but again, it has some advantages that make it worth knowing about. Some advantages of the IRR is that, well, it's expressed as a rate of return, which is kind of nice to be able to explain things to people, to describe the attractiveness of a project in terms of a rate of return, again, that most people understand. If you say this new factory will generate 18% rate of return on the capital we invest, most people would know that's a pretty good rate of return, a pretty good it sounds like a pretty attractive investment. Even if you don't know all the details about the cash flows, you can tell somebody this is the rate of return that's generated, and most people will have some sense of that. If it's high enough, like 20, 30, 40%, you may not even have to bother with comparing it to a required return, a cost of capital, which is kind of hard to do, as we saw in Chapter 14. Estimating the weighted average cost of capital takes some effort. And if you're very certain that the project's cash flows are such that it implies a very high IRR, it may not be worthwhile to bother estimating the minimum rate of return required. Usually, net present value and internal rate of return will give us the same decisions. A project that has a positive net present value will generally have an internal rate of return higher than the cost of capital. There can be exceptions to this, and those exceptions also give us a little pause to think about whether we want to use IRR as our only or our primary decision rule. One of the exceptions has to do with what's known as non-conventional cash flows. Now, what this means, it refers to a situation that might look something like this, where you have cash flows both incoming and outgoing, over the life of the project. Here's an example. Imaginary cash flows, $1,000 initial cost, $300 incoming cash flow in year one, $500 in year two, a negative $200, a cash outflow in year three, and another cash inflow in year four. If these are the cash flows of your project, the IRR criteria might not be the best one to use. Here's why. Anytime you're calculating an IRR, you're solving an equation for that rate of return. In fact, I could write that out again in terms of the values on this screen. So here's the expression for net present value. And we said that by setting this equal to 0 and solving for R, we find the internal rate of return. But the problem now is that when we have three changes in sign from time 0 to time 1, the cash flow sign changes from negative to positive. And from year 2 to 3, it goes from positive to negative. And then from year 3 to 4, it goes from negative to positive. It turns out that mathematically, when you have these three sign changes among these terms, you're going to have three values for R that make this expression true. And when you plug these into your calculator or plug them into the spreadsheet, you might get a result that solves the equation but isn't truly the internal rate of return of the investment. Basically, there would be three possible numbers that might come out, and only one of them would actually be right. So that's a problem that can happen when you have non-conventional cash flows where the signs change more than once. The IRR process can lead you to an incorrect result. Another problem that can come up with the internal rate of return process is when you have projects that are described as what you call mutually exclusive. Basically, the idea here is that if two projects are such that you can only choose one of them, and if you choose one, you can't choose the other, they're considered mutually exclusive. Each one excludes the possibility of investing in the other. You can go to graduate school at either Harvard or Stanford, but you can't do both. Those choices are mutually exclusive. Intuitively, it's not hard to deal with mutually exclusive projects. The logical thing to do would be, well, choose the project with a higher net present value, which makes sense, or if you're using internal rate of return, to choose the project with the higher IRR. Both of those are kind of logical, but it turns out that IRR isn't a very good way to make that decision. Here's a couple of example projects. Again, Project A and Project B. These are very simple sets of cash flows. Here we've got them arranged vertically from the initial investment at time 0 and incoming cash flows in year 1 and 2, arranged from top to bottom this time instead of left to right, but same idea as before. Project A has an outgoing cash flow, initial cost of $500 at time 0, and results in incoming cash flows of $325 and $325 over the next 2 years. That translates to an internal rate of return of 19.43%. Pretty good, but that's the result. And you can calculate that. You can verify that with your calculator or your spreadsheet if you want to. Taking account of the required rate of return that's specified up here as 10%, you could also calculate the net present value of these cash flows. And again, I'll leave that as something for you to do, but you would find that the net present value of those cash flows was $64.05, $64.05. Positive. Yes, it's a good investment by either criteria. An IRR greater than the cost of capital, it's a good investment. Net present value greater than zero, it's a good investment. So yes, Project A is worth pursuing. We also have Project B up here, which similar in length at least. It has a lower initial cost, 400 rather than 500. Same cash flow in year one, somewhat lower cash flow in year two. So have a lower cost and a lower incoming cash flow in year two. Doing the same calculations for IRR and net present value, we find an IRR of 22.17% and a net present value of $60.74. Project B also is a good investment because it has an IRR higher than the cost of capital, and it has an NPV that's greater than zero. So yes, both of these are good investments. But if they're mutually exclusive, if you have to choose either A or B and not both, which one do you take? Notice Project B has the higher internal rate of return, but Project A has the higher net present value. There's a conflict. You have to choose one or the other. You can't choose both. It turns out there's a very consistent rule in this situation. Always choose the project that has the higher net present value. Whenever you have a conflict like this, where net present value and IRR are giving you different signals, different decisions, you should always use the net present value to break the tie. The reason for that is that net present value is actually what tells us how much value is created by the project. In these examples, Project A and B, while it's true that Project B generates a higher rate of return on each dollar that's invested, because in Project A, we have more dollars being invested, it results in more value being created, $64 rather than $60 and change. If I had to choose between Project A and Project B, I would choose Project A because of its higher net present value. The fact that the rate of return, the value created per dollar, is higher for Project B, well, it might be nice, but it doesn't. Choosing Project B doesn't maximize the value of the business, and that's what we were setting out to do throughout the entire semester. So we've seen a couple of situations where IRR is what we call unreliable. When we have non-conventional cash flows, it can throw off the calculations. When we have mutually exclusive projects, we can reach a bad decision if we choose based on IRR rather than based on net present value. It's always good to consider different criteria when you're making a decision. There's no rule that says you have to calculate only one of these. So it's pretty common to calculate all of them. Net present value should be the primary decision-making rule because it does measure exactly how much value an investment creates. But IRR can be useful too in communicating that decision and justifying that decision to somebody else. Payback period definitely is secondary. We saw the weaknesses of it, the situations where it can lead to a very bad decision. That was in the second video in this sequence. It's commonly used enough that I think it's worthwhile to know about, but it's also worthwhile to know about the drawbacks of it. And again, that was covered in video part 2 in this chapter. Summarizing what was done in the chapter, criteria, discounted cash flow criteria for making investment decisions included net present value, which we said was the best, the one to use if you have nothing else. That's your primary decision-making rule. There aren't any real serious problems with using that, because when you calculate a project's net present value, you're calculating the amount of value that economic value that it creates, and that's what the goal is. So that leads us directly to that. Internal rate of return we just now talked about. We defined it in this way: the discount rate that makes the net present value equal to 0, which is a pretty short definition, but accurate. Usually it works okay. Usually it reaches the same conclusion as net present value as long as the cash flows are conventional, but that's not always the case. So there can be some issues when we have non-conventional cash flows or mutually exclusive projects where IRR can lead to less than ideal decisions. We did talk about payback period, and again, it's a secondary way of evaluating a project, of trying to get a feel for the risk of a project. It might be worth looking at, but there are some drawbacks that make it unacceptable as a primary decision-making rule. The ones that we skipped over, for example, discounted payback period, similar in concept to payback period. It's just that it involves figuring out how many years worth of present value cash flows, discounted back to the present time. How many discounted cash flows does it take to offset the initial investment? It helps. It resolves that issue where payback period doesn't account for the time value of money. Discounted payback does, but it doesn't really fix any of the other problems with payback period, and it's a lot harder to implement. So I'm not having us bother with doing any calculations for discounted payback period. You can skip over that one if you see it in the chapter. Similarly, profitability index is another way of evaluating or assessing the desirability of an investment. Basically, what this is, profitability index, is the present value of the benefits of a project divided by the cost. Whereas net present value was the present value of the benefits minus the cost. So you can see these two things are going to be mostly consistent with each other. If the benefits are worth more than the cost, that means net present value is positive, and it also would mean that the profitability index would be greater than 1, which is what's considered a desirable or an acceptable investment. If the profitability index is more than 1, if the benefits in present value terms are greater than the costs, then it's a good project. There are situations where this is useful, but again, it doesn't, like IRR, it does not deal well with mutually exclusive projects. It does not deal well with projects that are very different in scale or in the size of the investment, because profitability index is a measure of value created per dollar of investment, but not measuring the total amount of value created. Nothing wrong with it. It has its uses, but it's not something I want you to worry about in this course. The book does another one called Average Accounting Return. Not worth spending much time on that. It is based on project attributes other than the cash flow, measures of accounting profit and book value. And these things have very little to do with the actual creation of economic value, and just serious problems with this one. I don't want to spend any more time on it because it can often lead to poor investment choices. And so whenever you see AAR, average accounting return, skip over it. You're not going to be asked any questions about that. I think that's about it. I hope this has been helpful. Don't forget the assignments on Connect. There is a Learn Smart assignment and a homework over these topics from Chapter 9. In the next week, we'll move into Chapter 10, where we start to think a little bit more about how those cash flow estimates are obtained. We've been taking them as given in this chapter, but in Chapter 10, we'll try to figure out exactly how the cash flows in year 1, year 2, year 3, and so on are estimated.